Welcome to the Deep Dive. We're here to cut through the clutter and give you those sharper insights. Today, we are tackling something that trips a lot of people up. It's this difference, this crucial distinction between fair value gaps and, well, what people often just call random gaps.
Yeah, so our mission today is pretty clear. Let's clear up that confusion. We want you to walk away with some precise, actionable knowledge here. All our insights today, they're coming straight from this really interesting discussion called fair value gaps versus random gaps, the algorithmic truth. And, the way it's set up is kind of like a chat between a teacher and an analyst. It really helps frame things nicely. Okay, let's jump in. Time to unpack the algorithmic truth behind these price moves. So look at any price chart, right? Gaps everywhere. Feels like it sometimes. How? How do we even start categorizing them? What exactly is an ICT fair value gap in FVG? What makes it different? Right, that's exactly the starting point. We need a solid definition. An ICT fair value gap, or FVG, isn't just any gap. It's a very specific type of market inefficiency. The source material puts it nicely right near the start, saying it's that small little area in price action that is the thing that is the easiest to spot. Basically, what it means is you've got the specific price range where, well, transactions only happened on one side of the market, think buy side only or sell side only, and that creates an imbalance. An imbalance, the algorithm, the underlying program driving price, usually needs to revisit, to, reprice or rebalance things.
Okay, rebalance. So if I'm getting this right, it's about an imbalance that the algorithm has a specific reason, almost an intent, to fix later on. That idea of algorithmic intent, that sounds really central here. So then what about those other gaps? So the ones we might just glance at and call a gap. Is that what we mean by a random gap or maybe a common gap?
You nailed it. Picking up on algorithmic intent is absolutely crucial. That's the real differentiator.
Yeah, what many people call a random gap is probably better termed a common gap. Or if you're thinking about how price is delivered, maybe a liquidity void. The source clarifies this too. It says, a real liquidity void is an absence of any buying and selling. There's no printed data between two specific price points. Now, price might come back into these common gaps or voids eventually, sure, but they don't have that same, algorithmic must-fix tag attached to them that an FVG does. They lack that imperative for precise rebalancing. And that difference, it's fundamental, really key.
Ah, I see. So one type is like a note for the algorithm saying, come back here, while the other is just a space where nothing printed.
Got it. Okay, this is where it gets really interesting, I think. For practical use, can you break down maybe 3 key things that really set these two types of gaps apart?
Absolutely. Let's break it down. First key differentiator. Algorithmic intent and referral. This is huge. An FVG isn't just some random occurrence. It's something the algorithm actively refers back to. It's marked for later attention. The source really emphasizes this point. It says, if that gap forms, it's meaningful, it's salient. That means the algorithm will refer back to that same area again, and it will do so for weeks and months at a time. Weeks and months, that's significant. Common gaps just don't command that kind of sustained algorithmic focus, even if price wanders back there for other liquidity reasons.
Okay, wow. Weeks and months. So it's like a persistent bookmark for the algorithm, not just a fleeting thing. What's the second big difference?
The second one is all about market efficiency and delivery. Think about how price moves. An FEG represents a fundamental inefficiency in that price delivery. The source explains that price, essentially, has to leave this area once it offers a down candle passing through that same range. There's this imbalance left behind. And this happens because there's this underlying drive, an algorithm that delivers efficient market delivery. FEGs are basically the spots where efficiency broke down and needs restoring.
Efficiency needs restoring.
Exactly. Oh, now contrast that with the typical liquidity void. That's just an absence of any buying and selling. It's a void in the data, not necessarily an active imbalance. The algorithm is programmed to precisely rebalance in the same way.
Right, right. So one is like a job needing completion for the algorithm, the FEG, and the other is more like just a blank spot on the tape. That makes a lot of sense. What's the third key differentiator then?
The third one is the formation context, how it actually looks on the chart. FVGs are identified by a very, very specific 3-candle formation. This pattern signals significant forceful price movement displacement. It sounds a bit technical maybe, but the source lays it out clearly. It says, it's a 3-candle formation. The first candle's low has to be traded below on the immediate following candle. The next candle has to trade with an extended low as well that went below candle number 2, but does not trade with a high that trades back to candle number 1's low. What that creates is this small little gap where one candle only traded from the range of the candle number 1's low to candle number 3's high.
Okay, whoa. That's very
It
precise.
is. That specific structure is the fingerprint, you know? Now compare that to a common gap, like an opening range gap. That's simply the difference between where we settled the previous day at 4:14 p.m. to now the first opening price at 9:30 Eastern Time. It's just a price jump. It lacks that specific three-candle structure that tells us the algorithm has left an imbalance it intends to correct.
That detailed candle recipe, though, that's incredibly useful. It gives you something really concrete to actually look for on the chart, doesn't it? So, okay, theory is clear. Let's make it practical.
Yeah.
Could you give us a quick example of each, like how they might look or function day to day?
Sure thing. Let's start with the fair value gap. Think of it as like the gold standard of the ICT pattern. You might see it described in a setup, maybe something like a fair value gap with an overblock and optimal trade entry. And the implication is you can be long and expect price to reach for here and here. So it's acting as a really precise entry zone, or at least an area the algorithm is targeting. It's designed to revisit that spot.
Okay, so a target zone.
Exactly. And a common example might be after a sharp sell-off. You get a down-closed candle that creates what's called a SIBSI, a sell-side imbalance, buy-side inefficiency. Basically, strong selling leaves this void, this specific gap that the algorithm is likely to target later for upside price delivery to bring things back into, well, balance.
Okay, that paints a really clear picture. The FEG isn't just a gap, it's a signal, a marker for future algorithmic action. Now, what about the other kind, the common gap, the random one?
Yeah, the common gap. The classic example is that opening range gap we mentioned. Market opens, say, way higher than where it closed yesterday. Now, the source notes that if that gap is really big, it's not likely to fill in, maybe during that same day. Price might just run away from it. But the key difference, again, is that this opening gap doesn't inherently have that same algorithmic mandate for precise fill or rebalancing like the FVG does. Other things might pull price back there later, sure, but it's not the same mechanism as the FVG's built-in rebalancing need.
This is really clarifying things. We've got the definitions, the core differences, the examples.
Yeah.
So let's bring it home. For someone listening, trying to spot these in the heat of the moment, what's the bottom line? What's the decision rule to tell them apart effectively?
Okay, the decision rule. It needs to be straightforward, right? Here it is. If you see that specific three-candle formation showing an imbalance that the algorithm is clearly set up to refer back to for rebalancing and efficient price delivery, that's your fair value gap. If you don't see that specific formation, it's likely just a common gap or a liquidity void. And this isn't just academic. The source really stresses the importance, saying if there isn't one fair value gap there, you don't have a trade. It's about identifying a high probability condition, and that condition stems directly from understanding that algorithmic intent signaled by the FEG.
That rule really helps cut through the noise, doesn't it? A clear filter. Okay, but knowing the rule is one thing. Applying it is another. What are some common mistakes or pitfalls people fall into when they're trying to use these ideas?
Oh, definitely pitfalls exist. 3 big ones come to mind. First, and this is super common, trading every single FVG you see. Just spotting an FVG, that 3-candle pattern, doesn't automatically mean go trade it. You can't just do that. As the source material warns, you can't look at just every individual candle that may resemble a fair value gap and assume that you're going to have a trade on that. There has to be narrative wrapped around it.
Narrative, meaning context.
Exactly. Context, the bigger picture. Where is price coming from? Where is it likely going? What's the overall market story? The FVG needs to fit into that narrative.
Okay, so rule 1, don't just trade the pattern in isolation. Context is king.
Got it.
What's the second pitfall?
The second one is confusing these ICT concepts with standard retail interpretations. This happens a lot. People see gap or imbalance and immediately think, oh, supply and demand, or support and resistance. But that's missing the point. The source is very explicit here. What I'm teaching is a relabeled version of supply and demand. It's neither supply and demand or classic support resistance. These FVG concepts are built on the idea of algorithmic price delivery. It's a different model entirely, focused on how the algorithm functions, not just generic price zones.
That's a really crucial distinction. Using the right mental framework for the concept.
Okay.
Makes sense. And the third common misread.
The third one, and maybe it's a bit more subtle but just as important, is ignoring time and context, especially the time element. People might think all gaps are created equal, or they forget how critical the time of day is in this specific methodology. The source emphasizes that everything in this approach is directly linked to New York local time, and that everything runs by this algorithm on New York local time.
New York time specifically.
Yes. If you're not dialed into that, if you don't understand the key time windows, the kill zones, and how they relate to the broader market narrative, you simply won't have the same calibrations. You could see a perfect FEG pattern, but if it forms at the wrong time according to this model, or outside a key narrative element, you might completely misinterpret its significance. Time is not just a detail, it's fundamental.
Wow. Okay, FEG plus narrative plus correct time. That seems to be the formula. This has been incredibly illuminating, really getting into the weeds. So, to wrap things up for everyone listening, what are the absolute say, 3 takeaways they should lock in about fair value gaps versus those other common gaps?
Okay, 3 key takeaways. First, fair value gaps are specific algorithmically generated inefficiencies. The market, or rather the algorithm, intends to reprice or rebalance them. They signal precise areas of interest for institutional flow, and you spot them with that unique 3-candle pattern.
Specific and intentional. Got it. Second takeaway.
Second, common gaps, or liquidity voids, are essentially just price discontinuities, breaks in the data. They are not necessarily governed by that same powerful algorithmic drive for rebalancing, and critically, they lack that defining 3-candle formation.
Different structure, different intent. Makes sense. And the final crucial takeaway.
Finally, and this ties everything together, context is everything. The market narrative, what story price is telling, and crucially, the time of day specifically aligned with New York local time, these are absolutely paramount. You need these to correctly identify and effectively leverage fair value gaps. Without that broader picture, just spotting the pattern isn't enough. You might miss its true meaning completely.
Fantastic synthesis. Specific structure, algorithmic intent, and the crucial roles of narrative and time. Well, that brings us to the end of this deep dive. We've really worked through the nuances, haven't we? Moving past just calling everything a gap to understanding the algorithmic truth behind FEGs. Hopefully this gives you a much clearer framework, not just for charts, but for spotting intentional patterns versus just, well, random occurrences. So as you go through your week, maybe think about this. Where else, maybe in your learning or even just daily decisions, might you be confusing something that has a real underlying algorithmic or intentional structure with something that's just a common or even random event? Something to ponder. Thanks for joining us on the Deep Dive.